Good morning, YouTube. Today we are going to look at the two factors that are involved in making any investment, and also talk about how I look at those investments to value them, and additionally maybe a couple of the gaps that people would have into going into what I'm doing and how I solve those gaps. And also the fourth thing is, some things that I have that are challenges in solving those gaps. So real quick, I'll introduce you to the two factors. Number one is you calculate the intrinsic value of the asset. What that means is what the value of the asset is to you. This is not the sale price. This is not the appraisal price. This has nothing to do with what someone else thinks it's worth. It has to do with what it is worth to you. So an example might be if you bought a hotel cheap but didn't know how to run a hotel, it is not worth anything to you because all you can do is sell it because you don't have the skills to run it. So the intrinsic value is that. And then second is margin of safety. And margin of safety is a key concept, which means if I can buy something at the intrinsic value, then by buying it I have not accomplished anything. And so this margin of safety is, how much do I need to have in the difference between the two so that I should take action on that situation. So we will get right into this. So here's an area maybe that I look at houses in, and in order to figure out on the last sheet what the value is, I look at what the rents are for that area. And so if you look at this sheet here, I just rented a house for $1,600 a month. On that house I paid $210,000 for it, so that's an 8.5% cap rate, which is higher than regular cap rate. So if you take that and you say, okay, this is 7.5, which is probably a decent investment, then my margin of safety here was $30,000. And so by buying the house, I took action on that because instantly I made this $30,000. A portion of that then was absorbed into some fix-up, and so maybe I made, let's say, $20,000. But that $20,000 takes this from being an even investment to being a disproportional risk-reward investment. And I'll show you how I kind of make those calculations. So one of the four things I'm going to share is how do I make the calculations. So the way I made the calculations is I took the area that the house is in, and these are the houses that are for rent in that area. If we take the home types and we drop apartments, we drop townhouses because those aren't competing, we look at the area, we see what is rented for rent but not rented in that area today. Now, this is what's called kind of confirmation bias. So this might say fair rent is $2,000 a month. This might say it's $1,800 a month. But remember that this house, for instance, at $2,000 a month is not rented. So what you're looking for is at what rent rate would this house rent in the period of time that you want to rent it in with the skill sets that you have. So those three things. When you look at those, we'll look at this first 1800 right here. And this house is a little smaller than this. But look at the 1800. Oh, it's not even available. So we actually look at the details and it tells us we aren't even competing with a house that's not available. So over here, let's look at the 1600. Oh, look, it's a townhouse. That's not competing with us. Single family houses, townhouses, those aren't competing with two different things. Click here, townhouse, misidentified as a single family residence. Over here, this is a lower, smaller house, 930, you see it? Pretty nice, but very small. So we're not competing with that. So let's check this 2000 out. So this one's for rent for $2,000, and let's look and see how long it's been. 3 applications, 2 days listed. So it's kind of a bigger house than what we have. You could compare. but $2,000 a month is the new rent price. 3 applications in 2 days is pretty good on that. And so I would say this one's $1,300. This one would probably list it a little bit below what I would consider market, because market's probably $1,750 now, but at that point it was $1,600. And so this allows us to help establish what that rent value is intrinsically. Now, ideally what I do is I watch this rental market and I'll look and see how long it takes this to rent. So let's say this is $2,000 a month and my house was the same as that and it takes a week to rent, then that might be the new rental market. It might fluctuate some, but the problem that I have is looking, you can't see all the houses that were listed for rent and how long they took to rent historically. Now, on the purchase side, I might switch this market over here and say for sale and look and see what's for sale. Now, a house comes for sale. Let's say this 225 comes for sale here. Different area, different neighborhood, but similar, maybe a rental market. You come down, it's been on the market 3 days. Now, how long does it take this to sell at 225? Well, if it sells in a week at 225, it's not worth 225. It might be worth 240, right? If it sells in 3 months at 225, then it might be worth, 210. And so how long these things take can tell me an indication of what the rental market looks like. And I'm looking at that and kind of comparing the two and saying, what do I want for my cap rate, which is the percent rent that I'm getting compared to what I'm paying for that house. 7.5 is okay. Right now, government bonds are at 5%. And so this is actually low historically. But the reason these prices haven't dropped, one of the reasons is me as an investor, when I go in and I say, okay, 7.5% and current borrowing rate is 7.25%, let's say, I think, well, the borrowing 7.25 is fixed for 5 years. This rent's probably going to go up a little bit each year. And most likely in 2 years from now or 3 years from now, the interest rates are going to be back down low, where maybe I can refinance at maybe a 5% and have the difference between the two, and then this will adjust and the rent will adjust. And as long as I can carry the property for now. Now, if I expected 4 years from now the interest rates to be 10%, then a 7.5% would basically lock in a loss for me on this property, and I would say, okay, I'm going to buy this property to lose money. So I wouldn't do that. Now, one of the things you'll see in my spreadsheet here is I make it a simple spreadsheet of how I make the decisions, because you don't want so many factors in the situation that you get caught in analysis. You don't want so many houses that you know about that you try to analyze all the houses and you get caught in that situation where maybe you see 10 houses. The best situation for me is when I narrow my focus to an area and I say, I know this area's rents, I know the house values, and I'm looking for a certain house. So right now, let's say a house went for sale for $210, like I bought before. I would put an offer on that house on the first day. I would try to make the offer as clean as I could as far as any contingencies or things. And ahead of time, I'm trying to work out to make sure my offer can be the best offer, because my true motivation is that price when I buy, and then handing it off to Jackie or whoever's dealing with the rentals to manage that property for me. But one thing I was going to mention is in Lease Summit I have an adjustment because taxes are higher as a percent. So basically I consider $100 of rent a month to be just that extra taxes. And so if a house is renting for $1,600, I consider it rented for $1,500 versus the other areas that I'm in. Now, one of the problems I have is in order to establish a new area, I need to understand the rents. Not the rents on houses that aren't renting, but the rents on houses that did rent. There's not really a good historical way to check that. And also on the valuations, I need to know what the time frame is between when it was listed and when it closed. And that you can do by drilling down, but it takes time. And so right now I'm just in 2 areas. I will tell you a couple gaps that I take advantage of in those areas. And I'll show you an example. So if I go here and I switch to Rogers, Arkansas, there is a house that's for sale. It is not a good price, so don't buy it yet. But the house here is for sale in this neighborhood, okay? This neighborhood has a price point. This neighborhood, I'm switching my screen, I'm sorry. This neighborhood has a price point. This neighborhood has a price point. This neighborhood and this one. So every neighborhood has kind of a price point, but when a realtor looks at the situation, they don't draw neighborhood lines. What they do is they draw a circle around this and they pull comps. Comp sales to the circle. So this one is right next to another area. Okay? And because it's right next to this other area, right here, where the houses are 170, 205, whatever, based on square footage, these are valued lower than some of the ones over here in the same neighborhood. Okay? So that can create a gap where people think the house is less than it's actually worth. $340 is probably a pretty fair price for this house. If I look at my rent and my rent rates, I've watched this neighborhood. This rents for about $2,000 a month. Nothing is for rent today hardly. And so $340 is high. I would probably be more in the $300, $310 market for this house. So if I submit an offer, it'd be in that range. Most people really don't want an offer that's that much lower. So unless they started dropping the price, if they dropped it probably one more time, I would probably submit an offer on this house for those range. Otherwise, I probably won't fool with it. But I just wanted to share with you, sometimes a neighborhood boundary can create that. Let's say there's a house in this area and it's valued a certain amount, but the house you're looking at is on a lake. That lake may not be in the circle as far as the valuation, and so maybe it's mispriced because of that. I bought a house over here in this neighborhood, in this area. I bought it based on a 6-month comp when the market was on the rise. I knew that the price valuation of the house would have been closer to the very latest purchase price in that neighborhood because it was on the rise. But the valuation took a 6-month horizon. So based on that, even based on the straight, appraisal of the house, I could get a great deal on that house and buy it with a margin between what I was buying it for and what it was worth. But I just wanted to give you a little bit of a look into how to value any kind of asset. You find the intrinsic value. Some steps that I do to find that intrinsic value or keep track of it over time. And then lastly, that what you're looking for in all these deals is a margin of safety. And that is essentially what you're making when you purchase the asset. Otherwise, like if you can buy this at fair market value, and people might say, oh, rentals are a great thing to buy, and they'll buy this, right? Well, there's no margin of safety at $340. Rentals are a great thing to buy if you're buying with a margin of safety after you've established the intrinsic value of that to you. If you haven't, then you're just kind of moving money around, and it might make you feel really good to buy something, but you're actually not doing anything. You're actually not making money, and so that's not what I do. And so at $340, this might be break even. Maybe $300, $310. That would be a great deal. Will it go there? I don't know, but I'm not in a hurry, and I've just been watching the houses. Now, right now, am I buying anything? Well, no, there's nothing for sale here. So I've started looking to try to create this valuation to determine intrinsic value, rental value, and the margin of safety in another area. but I haven't put the time in necessary and haven't had the length of time to establish those things. So I hope this is valuable for you to understand. You can take this same intrinsic value approach and margin of safety, which is what Warren Buffett and Charlie Munger teach. They learned it from Ben Graham or some different situations they've been in. And you can take this and apply this to any type of asset that you're looking at buying that's kind of an investment or gives you a return. I hope this is valuable to you. Have a great day. Bye.